Good afternoon, everyone. Thank you for joining us for today's program. I trust you're all doing well, staying safe, and as the global vaccine rollout gives us some hope that we'll be able to engage here in person sometime soon. My name is Brian Enyart, and I'm a board member for the CFA Society Boston, and I'm going to moderate our program today. The program represents the fourth installment of our four-part distinguished lecture series that's brought to you through the partnership of CFA Boston and New Frontier Institute. Throughout this series, we'll feature topical presentations by widely acknowledged authorities on issues of interest across investment, the industry and to investment practitioners. In today's discussion, we explore one of the most interesting developments in financial assets in many years. Cryptocurrencies like Bitcoin are raising many provocative questions on the investment advisability of assets and return streams that we haven't previously had access to. And these new opportunities come with their fair share of risks. Some of them are known and some of them we don't yet know. The evolution of non-government sponsored currencies is not only a fascinating development in the world of transactions, but it also poses investment questions around when it's advisable to invest in or trade or even fund client accounts with cryptocurrencies. It's a subject that will require significant research, education, and disclosures before any of us will have any meaningful experience with cryptocurrencies at all. Today's presentation, which is titled, Who Owns and Trades Bitcoin? Evidence from the Blockchain, is based on the research and observations of Dr. Antoinette Shore from the MIT Sloan School of Management, where she's the Myers-Horn Family Professor of Finance. In her presentation, Dr. Shore will discuss her findings and thoughts. And I'll join you again later for the Q&A section of the presentation. And please note that you may submit questions through the QA function at the bottom of the screen. And now I'll turn the program over to Dr. Richard Michod, who will introduce our speaker today. Dr. Michod is the president and CEO of New Frontier Advisors and a member of our CFA Society Boston's Program and Education Advisory Council, where he helped sponsor this distinguished lecture series. So with that, Dick, please take it away.
Thank you so much, Brian, and thanks. Just a note about the lecture series before I introduce Professor Shore. This is the last of 4 speakers in the distinguished lecture series that I developed this spring with the New Frontier Institute, and as a member, as Brian noted, of the Program and Education Committee at CFA Society of Boston. The purpose of the series was to bring truly authoritative discussion on issues of great general interest to the advisory community and CFA members. The 3 prior speakers, Ron Ryan on pension fund management, Hendrik Bessenbinder on long-term investing, and Roberta Riccobon on ESG, set a high standards. Cryptocurrency is one of the most topical of issues facing investment professionals today. There is more than the ordinary amount of misinformation and controversy surrounding these new instruments. Today, I am very honored, and it is a very distinct pleasure to introduce Professor Antoinette Shore, a true authority in a number of fields in finance, including cryptocurrency, the focus of this presentation. So she is the Stuart C. Myers Horn Family Professor of Finance at the MIT School of Management. She is also a member of the Laboratory of Financial Engineering at MIT, a member of the Martin Trust Center for MIT Entrepreneurship, co-director of the Corporate Finance Program at the National Bureau of Economic Research, and a co-founder of Ideas 42, a nonprofit that uses insights from behavioral economics and psychology to solve social problems. She is an authority on corporate finance, entrepreneurship, and organizational economics. Her recent research includes venture capital, entrepreneurial finance, corporate diversification, governance, and capital budgeting decisions in firms, consumer finance, and new financial technologies. Some of her ongoing projects include how competition in credit card markets impacts consumers, the role of mortgage markets in the economy, applications of behavioral economics to consumer finance, and of course, cryptocurrency trading. Professor Shore holds a diploma in economics from the University of Cologne, Germany, and a PhD in economics from the University of Chicago. She received the Ewing Marion Kaufman Prize Medal for Distinguished Research and Entrepreneurship and was recently named one of the top 10 academics by AI-CIO magazine and top 3 most influential academics in the institutional investing world and Intelligent HQ magazine. She has published numerous research papers in the Journal of Finance, Journal of Financial Economics, the Quarterly Journal of Economics, and many others. Her work has been featured in The Economist, the Financial Times, the New York Times, and the Wall Street Journal. She recently published a paper, Trading and Arbitrage in Cryptocurrency Markets, in the Journal of Financial Economics. So please take it away, Professor Shore.
Thank you so much, Dick, for the kind introduction. Let me share with you all my screen and my presentation. Let's see that I can get this done. Yeah, good. Yes, I'm really delighted to be with you all today. What I want to talk about indeed is some ideas based on research that I have done with colleagues on trading of Bitcoin and what drives Bitcoin valuation. So the roadmap for today is I just want to very briefly kind of give you kind of my 3-minute summary of the key highlights of what Bitcoin is hoping to address, and then we'll think about what are the drivers of demand that ultimately would affect pricing in Bitcoin. And then I'll also talk to you a little bit about trading strategies, in particular potential arbitrage strategies at the end. But kind of, I thought to get us started, right? We don't want a computer science-based, cryptology-based introduction into Bitcoin. But if you remember, basically, Bitcoin was originally conceived, if you want, by a paper by Nakamoto in 2008, that then in 2009, Bitcoin became actually tradable. And famously, one of the very first commercial transaction, if you want, of Bitcoin was Laszlo Hanyek buying 2 pizzas on May 22nd, 2010 with 10,000 Bitcoins. And supposedly this little hand here is his son's hand when he actually received the cryptocurrencies. Now, if you think about this today, Bitcoin is traded at $48,000. This was probably the most expensive pizza in the history of mankind. But that was probably also the first proof of concept. So with this, right, we'll obviously kind of what is cryptocurrency and what in particular are Bitcoins. Many of you have of course heard that it's at its heart, it's a protocol that supports a decentralized and pseudo-anonymous digital currency and a ledger where within blocks on the blockchain, these transactions are stored. And why we say pseudo-anonymous is obviously that the flow of transaction itself can be traced on the blockchain, but typically we don't know who the holder of the account is. This has many benefits because it means you can actually trace transactions on the blockchain, but it also, as we'll discuss later on, comes therefore with lots of challenges, especially for regulation and especially for, if you want, tax enforcement, law enforcement, because these type of digital currencies then can flow across countries and across regions. And it is still a big challenge of how, say, to enforce KYC norms, anti-money laundering laws within this type of environment, right? Now, this is kind of the aim of the blockchain. Of course, in order to achieve this, to make this type of system work, what we have as well is that there is a system that is called basically the mining protocol, which achieves consensus on a proof of work, meaning solving certain types of puzzles to secure that transactions on the blockchain that are stored on the blockchain indeed have been verified by a by a miner who is involved in achieving this consensus. Now, in order to give incentives to these miners to actually engage in that verification, the Bitcoin coins are being awarded to each miner who is indeed engaging in this verification. And this is what is often also called the scarce token, that are then first received by the miners and of course sold typically on exchanges and then get into circulation. And the idea of the Bitcoin protocol is that we will have 21 million Bitcoins ultimately in circulation. Once this cap of 21 million is reached, actually, in order to keep the if you want, the Bitcoin universe from working, or no, to keep it working and keep it from collapsing, right? Then every transaction on the blockchain will have to be compensated by transaction fees once miners are not receiving Bitcoins themselves anymore. So this is the setup, right? And the promise of Bitcoin, basically the idea that it is a payment system that is not relying on centralized trust. So this is my little way of basically emulating, right, our typical payment system, whether it's a MasterCard, Visa card system, or if you think about your bank, right, there, the idea is that verification of transactions happens through a centralized trusted party, like a financial institution. But if you're concerned about either how efficient or how trustworthy these centralized systems are, right, here a system like Bitcoin is meant to provide an alternative, because through the blockchain and the verification process, we don't have one trusted central authority anymore, but we basically have a network or a protocol that then supports this network of mutually connected and mutually verifying entities, if you want. Now, this is kind of my starting point, because if you have this type of system in the back of your mind, right, then the question becomes, what are the drivers of value for a payment mechanism or a payment system in general? And then, of course, right, where would a system like Bitcoin add value? So the first idea, if you want, right, that was discussed when Bitcoin in particular came into being or was conceived, was this idea: can Bitcoin serve as a substitute for our typical payment systems, like, as I said, credit cards like verification like Visa or MasterCard? And in order to compete with the existing payment systems that we have, right, we need to think about how does it stack up in terms of transaction cost, in terms of speed of settlement, and then also in terms of safety. So let me give you some markers that many of you might have already seen, but that actually suggest that as a payment mechanism, meaning, you know, supporting transactions on a day-to-day basis as your credit card does, on that basis, crypto seems to be, sorry, I should say, these type of proof of work, Bitcoin type tokens seem to be a very bad substitute. Why do I say this? So the first thing is that Bitcoin in particular is extremely energy inefficient. So some of you will probably also have seen this, right? But you can see this in two very simple charts. First, if you look at the level of energy consumed, this is from the Cambridge Center for Alternative Funding, as of literally estimate of today, Bitcoin miners and verification ranks in terms of its terawatt hours of energy used. It literally ranks just above Malaysia or below Egypt, right? Countries with multi-million population. And remember, this is in order to substitute for something actually relatively energy efficient, like say your credit card verification system, right? So from just the energy consumption basis, Bitcoin doesn't stack up so well here. On top of it, this is level effect, right? On top of it, I wanted to show you another interesting factor from that it's not just the level of energy consumption that is relatively inefficient, but also Bitcoin energy use scales, in fact, scales quite non-linearly with the price of Bitcoin, meaning that whenever the price goes up, right? If you remember in the beginning of end of 2017, beginning 2018, kind of we saw a run up, we saw a little bit of a run up during this time period. And then of course, now at the beginning of 2021, right? What you see is basically, this is the yellow dark line is the average estimated consumption worldwide, energy consumption of Bitcoin. And then these are basically the upper and lower estimated bounds. But no matter which of these lines, kind of you stare at, what you see is basically that whenever the price of Bitcoin goes up, so does non-linear the energy consumption. So if indeed now, say, a majority of financial institutions or a majority of people were trading in Bitcoin, right, this would become even more often a problem for energy consumption and an environmental problem. So on that dimension, right, it's already not so great. On top of it, we typically want from a payment system that it is not just energy efficient, but also that it is quick. Now, by its very nature, the Bitcoin protocol actually on average takes about 10 to 15 minutes to verify a transaction. But that can even vary over time. So I'm plotting here for you the median time for a transaction, including the miner fee, to be reported in a mined block and then added to the public ledger. And you see, right, not only is the median time, right, somewhere between 10 and 15 minutes, there's also the additional, if you want, downside that when the price goes up, and there's a lot of competition for information being mined, right, the transaction times actually slow down. These are all not great dimensions for a payment system. And so I wanted to show you as a final thing on this argument that indeed, if you now look at the public ledger that records all the type of transaction that Bitcoin users are engaging in, this is from work that I'm doing with the co-author mine, Igor Makarov at LSE. What we did here, we inverted the blockchain. So we took all the hundreds of millions of transactions that have happened already on the blockchain, and instead of storing them in blocks like the blockchain does, we turned them into financial transactions, and we traced them through the ultimate receiver of the transaction. Obviously, I wouldn't know if it is kind of myself, somebody else, right? I don't know an individual typically, but I do know in entities that are trading and engaging on the blockchain. In particular, I know the addresses of many of the largest exchanges that are trading on the blockchain or that are transacting on the blockchain. Think of Coinbase, Binance, Kraken, all the names you've heard. And so look, what you can see is, especially in the last 3 years, but ultimately for almost now a decade, what we have seen is that the predominant use of Bitcoin is trading. The amount of transactions itself have become really minimal. I know there are lots of people who say, oh, Bitcoin is mainly used for scams and gambling and illegal transactions. A little bit it is also, right? But by now, those transactions have become a very small fraction of engagement on the Bitcoin blockchain, and the majority really is trading. So why is that very important to know? Because it basically means that ultimately, if we were to build the value of Bitcoin on the fact that it will at some point substitute for all the payment systems like MasterCard, Visa, etc. that we have, that would be a very bad theory to have. And so, kind of clearly, Bitcoin cannot have achieved its value of, by right now, it's I think $48,000 as of today, right? Because of the idea that it will substitute for a payment mechanism. Now, if that's out, right? So what is left, right? What is left, and more people are now, who are crypto enthusiasts, are using that argument to support the idea that the value of Bitcoin should be as high as it is right now, or even higher, right? So what do people say? What they tend to put forward is the idea that Bitcoin could be a store of value. It could be the next gold. And so let's think about that. And indeed, what I want to show you here is, right, the type of assets that we normally like as a store of value, say, the US dollar, some people might indeed say gold, but, the typical asset that is seen as a good store of value should in particular show low volatility, right? And should show little correlation with other fundamental risk factor in order to be a good hedge or a good store of value. And then at the end, we can talk a little bit about the Sharpe ratio of Bitcoin. And here, right, when we think of this, even as a store of value, what I will argue is that it's not clear that Bitcoin has actually shown any superiority, or in fact, it's questionable whether it really will be a good store of value. As it stands right now, it doesn't seem to be at all, because look at this, right? So this is, I just plotted this simple statistic, using Bloomberg, but I can, any data you want would show you the same thing. What I want to show you here is just the 60-day volatility of Bitcoin. Compare this even just to gold, right? Gold is the blue line, Bitcoin here is the black line. And what you can see is that even though the market capitalization of Bitcoin has grown dramatically over the last 5 years, volatility has not gone down much. In fact, it has stayed as high as it was early in the 2010s, right? So often we might see that certain type of securities, when they are really young or in its complete infancy or traded very, very thinly, you get situations where, the volatility is very high, and then over time it comes down often dramatically, right? That's even true for many stocks. I plotted this Tesla in comparison for you, but it's one of the very unusual stocks that actually, similar to Bitcoin if you want, maintain massive volatility even with big market cap, right? Typically, we see that highly traded stocks actually start reducing its volatility. That is not true for Bitcoin. And that's actually not a good sign that, despite the fact that we now have actually quite high market capitalization and the opportunity to trade on many different exchanges, volatility is still very high. On top of it, and that's related to the volatility, in a recent paper of mine in the JV in 2018, we also show that actually the price impact of volume or of flows into and out of of Bitcoin in particular, is very large, and it is persistent. This again is also tied to volatility, but it basically is saying that individual traders can have big impact on the price of Bitcoin by moving money in and out of that security. So, for example, what we find in that paper is that buying about 10,000 Bitcoins raises the price of Bitcoin worldwide, actually, so across all the exchanges, by about 4%. That's actually massive price impact, which is not in line with, kind of any other stocks, let's say, that you see traded on the NYSE or kind of NASDAQ, etc. Right? Why am I making a big point of that? Actually, because when you come back to analyzing the blockchain, meaning who is owning Bitcoin and who is holding Bitcoin, you can see that despite the fact that now Bitcoin has been in the press for more than a decade and many people probably have tried to trade a little bit in Bitcoin or so and have tried it out and so on, despite that, what you might have thought bigger participation, the ownership of Bitcoin is still extremely concentrated. So this is basically, right, as I was telling you, from the same research project with my colleague Igor Makarov, using the Bitcoin blockchain, I can show you that, right, over the last almost 10 years now, the concentration of ownership has not come down. If anything, it has gone up a little bit. But what this is telling you, this is the green line here, is the fraction of ownership of Bitcoin held in accounts that are the 0.01 largest holders. And remember again, right, I don't know who these entities are in many cases. I just know that this is an account or, kind of an address, it's often called, on the blockchain that holds a certain amount of Bitcoin. And so what you can see, right, is that even when I just look at these addresses, the top 0.1% hold about 30% of the entire Bitcoin in circulation. If we look at the top 0.1%, it's already 60%. And then, kind of the top 1% own about 85% of all the Bitcoin in circulation, right? So this tells you basically that still the ownership of Bitcoin is extremely concentrated in the hands of few holders or few traders. We don't exactly know who they are, but given what I told you about price impact here, right, they have the ability to rake massive price impact and massive volatility in the price of Bitcoin if they so choose. So, kind of that's not a great setup for a store of value, right? And this is something that one should really keep in mind when thinking about the further evolution of a cryptocurrency like Bitcoin. So that's the first point, right? The point of, volatility in Bitcoin seems high. And given the massive price impact and the concentration of ownership, it's kind of tough to see that it will go away very quickly. Now, the second argument I want to discuss with you is many people have put forward this idea that, but what is nice about Bitcoin as a store of value is that it seems to have low exposure to other risk factors. So in particular, there's an early paper by two scholars at Yale, Liu and Czerwinski, that have shown, for example, if you regress Bitcoin returns on many of the typical factors or factor loadings that we like in finance, right? Or that we have seen in finance, like, market portfolio, small versus long, kind of value stocks, momentum, and, kind of the typical risk factors in finance. So if you regress Bitcoin returns on those factors, what you see is that the correlation is very small, and in many cases not existent. I mean, basically there is little correlation, right? And so people have touted this as a benefit of Bitcoin, which is that, kind of originally, meaning, let's say in the first 5, 6, 7 years of its existence, there was little correlation to other known risk factors. there was also little correlation with other commodities like gold, platinum, kind of silver, and so on. Now, what has changed in this narrative recently is that we start actually seeing more correlation. It's still the case that the overall correlation is relatively small, but what we have seen, for example, in a recent paper by Chazonis and co-authors, is that especially in situations or in moments when there are massive drops in price or massive increase in price, these correlation structures seem to have changed when Bitcoin utilization or Bitcoin, kind of trading increased. In particular, right, what does this graph show you is that this is a correlation of, say, treasury, gold, or cryptocurrency with events where stocks, kind of dropped by 1 standard deviation or by 2 standard deviations, and then the same thing at the monthly level. And what you see, not surprisingly, right, is treasury bonds are uncorrelated, or if anything, are negatively correlated with stock price movements. So is gold to some extent, but crypto, if you look over the last couple of years, you actually see that that correlation structure is not favorable. What this is in particular telling us is that in kind of events when the daily stock price dropped by 1 or 2 standard deviation, meaning by very large amounts, we see actually crypto drop too. So, famously, obviously, in March of 2020, when in the US, right, stock prices started dropping and there was a lot of stress in financial market, that's also when we saw a major sell-off in cryptocurrencies. And then also more recently, right, when the stock market gained, kind of had high gains, we saw crypto recovering too. So while this is a recent phenomena, it seems to suggest, right, that this kind of lack of correlation between Bitcoin and other asset classes or other types of securities does not seem to be a given, and if anything, seems to be actually reducing right now. So this is why, I would, from my research and what I've seen, I would think that Bitcoin in particular is a very questionable store of value, and with it, therefore, very questionable as an asset class, if you want. In particular, I personally believe that it would be a huge mistake for the US regulators to allow financial institutions, regulated financial institutions like mutual funds, ETFs, and so on, to start trading in something like Bitcoin, because of the negative properties that I just talked to you about, but also because I believe that we are too far away from having the ability of tracing the ownership of Bitcoin across different owners and different jurisdictions. And therefore, if we allow, say, kind of Tesla to be paid in Bitcoin or any other type of kind of transactions to be paid in Bitcoin, we will have massive problems with tax evasion, with money laundering, and potentially, will be encouraging a lot of malfeasance, if you want, because we might not know where money or comes from and where it's being injected from in our money circulation. So one final thing I want to say before I talk about Bitcoin as a speculative asset is, some people say, and that's why I put this here, but the Sharpe ratio of Bitcoin has been high over the last, say, 2, 3, 4 years. And the answer is true, it has been high, right? But it has been high on the expectation of other people putting their money into Bitcoin, or even on the expectation that regulators will allow mutual funds or ETFs and so on to start trading in crypto. the short of all this is that, of course, that in the run-up to a bubble, Sharpe ratios typically look high. That doesn't mean that high Sharpe ratios are sustainable in the long run. And in fact, if you think about what you now know about crypto, I should say about Bitcoin, right, is that it's not clear that very high Sharpe ratios can at all be sustained in an asset that at its heart is actually non-productive, right? It doesn't produce anything, and therefore it is not actually hedging any real risk in the economy beyond potentially inflation risk. Therefore, once, you know, if it was the case that a larger set of people were actually starting to have already started trading in Bitcoin, right, the Sharpe ratio would have to go down and ultimately would not be sustained at a high level in equilibrium. So then ultimately, right, what I want to highlight is that while, you know, cryptocurrencies seem to be, you know, kind of at a very high level of valuation right now, especially something like Bitcoin, there's not really a good argument for it to be either a replacement for our typical payment mechanism, nor a good store of value. So ultimately, right, what is left is that it is a speculative asset. And it seems that there are lots of people who are actually happy to, or even, you know, kind of derive utility from speculation. I'm not against, right? People can speculate if they want. That's not something I want to, you know, argue against as an economist. But I believe we need to be very clear about the fact that this is really a speculative asset, not a store of value. And in my last few minutes, I want to now kind of turn from, you know, kind of the, you know, I want to turn to thinking about how speculation seems to be happening in cryptocurrencies, and in particular, where we have seen a lot of speculation, but also a lot of arbitrage, is actually in the cross-section, meaning we have seen a lot of trading across different exchanges in Bitcoin and other cryptocurrencies. Because what's really interesting, if you want, from a finance perspective, is that we have a situation with Bitcoin where the same underlying asset is traded on many exchanges around the world, right? That's very rare, because typically a given stock is traded on NASDAQ or on NYC, but not on 15 other exchanges at the same time. Here, that's not the case, right? We know that the same cryptocurrency can be traded not just on different exchanges within the US, say, you know, Coinbase, Kraken, Gemini, etc., but also across the world. And this trading across different exchanges has shown us actually very interesting dynamics. So this is work that or some of the results I show you now are based on some work I've done that was published in the JFE in 2018, but I will show you the data, you know, updated to today. But what we find there is basically that the history of Bitcoin trading across exchanges is marked by recurring episodes of arbitrage opportunities opening up and closing again, and then opening it again and closing again. So this is actually quite unusual, because often arbitrage opportunities open up in financial markets, and once people learn about them, enough arbitrage capital flows in to close it, and you know, kind of in a way keep prices in line after that. But here we see really these recurring arbitrage events, even though over the last years, two years, the arbitrage spreads do have come down and have become tighter. And I talked to you a little bit about, you know, what seems to be driving those arbitrage spreads. In particular, we find that there seems to be strong market segmentation across different regions that contributes to those to those arbitrage events. So just to be completely clear, what I will be looking at when I talk about arbitrage opportunities, or price deviations opening up, is literally this idea that I have the same Bitcoin traded on multiple exchanges at the same time, right? So, they think about, Coinbase versus Binance being a tether-based, right, stablecoin denominated exchange versus, say, Coinbase in the US. And of course, if there are big arbitrage deviations or price deviations across exchanges, we would expect arbitrageurs to buy Bitcoin on the exchange where the price is high and sell it, where it's low, and sell it on the one where it is high. If that type of arbitrage was able to happen frictionlessly, right, these prices should come together or should converge very quickly, especially given that it's the literally same underlying. As I will show you, that is not the case. So what you can see, right, this is kind of from some work that I've done using data on the 20 largest and most liquid crypto exchanges around the world. And what we do here, we call it global arbitrage index, but we basically think of it as calculating an index of the price deviation within a given minute, right? We can also do it within a given second, but kind of within a given minute, I look at the price of Bitcoin on the exchange where it is the highest versus where it is the lowest. I differentiate it, and I'm showing you the daily average deviations. And so, of course, right, if this was an arbitrage-free market, you would always be hugging one here, right? So it should always be the same across all exchanges. But you see, this is by far not the case. Famously, right, in the end of 2017, beginning of 2018, we saw massive price dislocations, especially between the US, Korea, and Japan. But you see, and I'll show you a bit more about this, right? You see that this actually has come down since then, but we are still at a level where we have something like many episodes of daily price deviations of more than 5%, or sometimes even right close to 10%, which is something, right, that you would never see on, say, regulated stock markets like, say, the NYSE or NASDAQ. Yeah. Now the question is, why do we see these deviations, and why are they not, more quickly reduced? Just, in the last 2 minutes of my time, right, what you can see is that those price deviations or those arbitrage opportunities seem to be particularly large across different regions. So, for example, between Korea and the US, we saw, price dislocations of more than 40% in a given day. This was already, right, 2018, where the price reached, kind of $10,000. So that was often a premium of almost $4,000 between, say, the price in Korea versus the US. Or in Japan, it wasn't as dramatic, but even in Japan, right, there to the US, right, this is Japanese exchanges to US exchanges, we see price dislocations of more than 10%. In fact, I'm sure many of you have heard about the famous kimchi premium, right, in Korea versus the US. That is really quite unusual. And then let me just very quickly also tell you that if I look at the same time period, right, and I look at Bitcoin traded within a given country. So now this is, Bitcoin traded within the US, within Europe, within Japanese exchanges, within Korean exchanges. Actually, stunningly, right, you see that the price dislocations are much, much lower. So this is kind of the x-axis here, right, it is kind of same time period, and then you see that on average the dislocations are less than 2% within a country. Even in Korea, right, where I showed you the massive kimchi premium to the US, within Korean exchanges, we do not see these type of arbitrage opportunities. So what's, then the question is, what's going on here, right? And what seems to be going on, by the way, this is just to show you the same is true for Ripple, the same is true for Ethereum, even though that is currently not, kind of our focus. So what seems to be the case is that constraints on the movement of arbitrage capital, in particular arbitrage capital across countries, seems to restrict some of the opportunities for arbitrageurs to undo these price deviations that I showed you. So, kind of in other words, right, what it also, of course, shows you is that countries where the movement of fiat currency is more restrictive will see larger deviation in prices than those where the movement of fiat currency is more open. And just to make that final point, what we did here is we correlated the arbitrage spread or the arbitrage index across different regions. And interesting, what you can see is that countries that, kind of in some sense, countries that have the most restricted or the least open financial markets tend to have not just higher levels of arbitrage spread, but they also seem to actually co-move more. While countries like, say, the US, Europe, kind of, and Australia, for example, and the UK, right, you see actually that arbitrage deviations between those markets are much more minimal, and they don't move as much together, which basically suggests that those countries where the financial system is already functioning better and is more open, is actually the one where we don't see as much of a constraint on the movement of arbitrage capital as well. So let me finish. I know this was a lot of material in kind of a limited amount of time, if you want. What are the main takeaways that I hope I conveyed in this talk is, on the one hand, that as it stands right now, Bitcoin is predominantly a speculative asset. As I argued, right, we cannot expect it to ever be a good medium for a replacement of a payment system. It's just not designed this way, and it just doesn't work this way. But even as a store of value, it looks actually of very limited value, in particular because it's an unproductive asset that doesn't actually provide any hedge for real risks in the economy. And the amount of volatility that we're seeing and the massive price impact that individual traders can have on that asset make it even more questionable that this is a good store of value. And then the second part of my talk, what I showed you is that if you do want to be speculating in the market for Bitcoin and other cryptocurrencies, you should really think about it more from the perspective of, can you actually trade across different exchanges and take advantage of some of the price dislocation across exchanges, given that we have seen that across some geographies and locations, right, there seem to be arbitrage opportunities that open up at certain points in time. And at least, my interpretation of those episodes is that in times where in particular in times where the price of Bitcoin skyrockets, the existing arbitrage capital gets overwhelmed by the kind of in a way enthusiastic noise traders who drive up the price. And and basically, you know, kind of then open up these price deviations. Great. This is where I want to stop now and see what questions and responses people have.
So thank you, Antoinette. I've seen there's been a ton of really good questions that have come in, and I'm going to start just with one that strikes me from your work here. So you've done a lot of work looking at the blockchain to understand who the largest holders of the cryptocurrencies are. And that work has been pretty innovative. Just can you share a little bit more about why who those largest holders are is so important?
Yeah, that's a very good question. So the reason why we started really looking into this is because, you know, as I was alluding to in the talk, we saw that there's this massive price impact that, you know, individual trades can have on cryptocurrency markets, which is quite unusual, but it also means that individuals and their trading, right, can affect the price. And in fact, right, can affect the ability to potentially even manipulate the price. And so that's why we wanted to get an understanding, you know, kind of who potentially are these holders. And so this is kind of why, you know, for example, we saw that, you know, a lot of the concentration in the holding of Bitcoin has not gone down, which basically means, right, that, you know, kind of there are massive pools of cryptocurrencies sitting that can be deployed. And if somebody was willing to actually engage in destructive trading, to say create volatility in the market, they actually have the ability to do so. The other thing I can tell you is from this work, what we see is actually that these very large holders, they trade counter-cyclically. So they trade when the price is high, and afterwards the price comes down. And obviously I don't see the actual trade, but I see when these big addresses are sending money to exchanges. And so they are pretty counter-cyclical. The new addresses with small balances that are coming in, right, which is a good proxy for people who probably are more, you know, kind of recent adopters and small traders, they are very pro-cyclical. So they buy when the price is already high, and then, you know, kind of are actually affected by the drop in prices. And so, you know, this imbalance already tells you, right, that this is kind of a, right now still an environment where kind of some large holders really are behaving quite differently from, say, the noise trader and the day traders.
So if you were a large holder of Bitcoin and you wanted to get out, it's possible that you're going to see some gapping in price because of some of these behaviors of large holders. So there's a liquidity, I think this gets down to, there's a liquidity question here, that the liquidity is going to be available when you want or need it if you're a large holder, and you may be subject to price movement based on some of these larger holders.
Exactly, right? Absolutely.
Okay. Thank you. So I'm going to go to a couple questions here that came in I thought were particularly interesting. So this is a question around using Bitcoin for just financial transactions. Says, I agree with the arguments that comparing, say, Bitcoin to credit cards, and I think the settlement times, the credit cards are still cheaper and faster than a wire transfer, but perhaps this is a good payment mechanism for maybe large transactions.
Yeah, so good question. What is true, right, is that once transactions become very large, the price doesn't scale with the transaction size, right? Because you basically pay the fee and you have the same amount. So that's true, right? In terms of pure transaction costs. But keep in mind, right? I mean, we saw at the height of 2018 and also beginning of 2021, the fees themselves can go all the way to $80, $90 on top of the Bitcoin being mined, right? So that's still way more than at least my bank charges me, even for pretty large transaction. And I don't, you know, obviously, you know, there are limits to the size of my transaction and, you know, kind of what some of, you know, institutions do, of course, right? But beyond that cost, what we have to keep in mind that right now, the entire Bitcoin universe, if you want, is completely cross-subsidized by the high price of Bitcoin that the miners are currently still receiving, right? So miners, in a way, are willing to charge relatively low fees for each transaction because for mining every block, they are receiving currently a $48,000 Bitcoin, right? And expecting that this stays pretty high, right? Once we reach the 21 million cap, they will not receive this anymore. So at that point, everybody will have to actually pay for the transaction costs. And given what I showed you about the energy use and inefficiency, that can become very, very high. So in that sense, right, it will just never scale in terms of efficiency at the level that, you know, kind of a centrally controlled system with a trusted intermediary in the middle can achieve. There's just, you know, it's just not a scalable system in the way that, you know, kind of a payment system with a trusted intermediaries.
Okay, so
you know, these are all very interesting questions you're asking. I want to say one other thing that I hope people also keep in mind, because another inefficiency of the Bitcoin universe is that I understand that people, you know, kind of people have made the argument a lot that if you do not trust the intermediary in the middle, you might be willing to endure some inefficiencies, right? Because it could be even more inefficient or worse than inefficient, right? Even more ineffective if you learn that, you know, whoever the trusted intermediary is just ran away with all your money, right? So this is surely in emerging markets where we've seen many banks fail, for example, you might say, right, that it's better than to have a very energy inefficient system and be done with it, or endure the cost. But I want to say two things. In order to justify this as an argument, first of all, you will have to have a system that really engage in expropriation, which is not something we have seen in the US. But more importantly, remember, when you send your Bitcoin anywhere, you have to trust the receiver not to be a jerk. So while you might not want to trust your bank, when you send Bitcoin, if you were able to send Bitcoin to Amazon to pay for anything, right, or to send to some friend, you have to trust them when they receive your Bitcoin, not to pretend that they have already sent you the goods or that they never received this money, because you have no way to ever get it back, or you have no way to prove who is the holder of a given Bitcoin, right, if they don't want to play ball. So it's not the case that transacting in Bitcoin means you don't have to ever trust anyone again. That's not true. You just now have to trust your transaction partners completely, because they can engage in that behavior.
So the clearing, if you don't trust the clearinghouse, that might be good. But if you need the clearinghouse to make sure that if you're exchanging goods and services that you get what you had paid for, you know, potentially the clearinghouse is actually helpful for you.
Absolutely,
you know?
right? It's like, you know, kind of the many people now, right, are eager to use kind of payment apps from fintech companies. And then, you know, kind of that are charging them almost nothing. But if you send your little dollars to someone who by mistake, right, you put in the wrong cell phone number, you know, there are lots of things, lots of evidence, right, that people actually are shocked that suddenly they can't claw the money back as they are used to with your credit card, right? And so these are all things that we are in some sense taking for granted in our current payment system that right now is not actually, you know, provided in these new systems.
Okay. So here's a question that is very similar to the one we just had. Maybe this is a quick answer because you spent some time talking about this, but do you have any expectation that transaction time efficiency improves as the cryptocurrencies mature?
This is a very good question, because so I would say on Bitcoin, under the current protocol, no, it just doesn't, it doesn't work, right? It can't. Now, it's possible, right, that Bitcoin, the Bitcoin community could decide to change the protocol and the verification mechanism that they're using, and they could switch to a different one if they so wanted, right? But first of all, it would need coordination. Second of all, if you think about it, the existing miners in particular have invested in a particular mining technology. And right, a lot of Bitmain in particular is one of the big providers of, of infrastructure and so on. So it's actually not necessarily in their interest to make themselves redundant and invest in completely different technology. So the users of Bitcoin actually are beholden to whatever, kind of the big holders and the big miners are what is most in their self-interest, right? The other thing I should say, right, there are other types of cryptocurrencies that are more like a permissioned blockchain, say, like a Ripple, right? The argument about inefficiency does not work there. That's not the case, because you don't have this proof of work type of verification that is so energy inefficient. But of course, right, ultimately, Ripple is much closer to what your credit card company is, because it is a permissioned blockchain. So you do have a central set of controlling entities in the middle.
So this is I'm just pulling a question that's kind of related to this thread you're pulling on here. Is, would it be possible to devise a cryptocurrency that avoids some of the Bitcoin inefficiencies? And you just hinted that some of these cryptos have different characteristics. I guess maybe if I reframe the question, could you devise the ideal characteristics of a crypto that sort of avoid most of the pitfalls you're nervous about?
Yeah, I guess, that's why there are now thousands of coins in circulation, right? Because everybody is trying to do exactly, is in a way experimenting with this. So what I would say is the following. If we've seen, right, cryptocurrencies that are more efficient from a, resource use and resource utilization, they come closer and closer to our traditional systems, where a, kind of central, permissioned, centrally coordinated system is actually controlling the, kind of the functioning of the system, right? So even say proof of stake is somewhere in the middle between proof of work and, something that's, kind of just permissioned by a few entities, right? So that makes it much more it makes it somewhat more energy efficient. But the more you want to be fully decentralized, like a Bitcoin, the more you have to endure, these inefficiencies. And, I mean, in a way, the logic, right? I mean, it's the same thing as saying that the most efficient thing that you can have, right, is a trusted entity that does everything right, and you don't even have to spend the time of regulating it, right? Now, this is obviously, we know that this doesn't really exist in reality so much. That's why we do also spend a lot of effort and time to supervise our banks, to regulate them, right? To make sure that we know who's owning them, that the people who are owning them have some of their own money at stake, and therefore don't let the banks collapse, or we have a whole Fed system, right, regulating it. But the thing, that's also resources spent, but it's, kind of actually not comparable to what we right now spending in energy on something like Bitcoin. And, one thing that we haven't mentioned so much yet, but it is actually true, that if you look, the mining industry for Bitcoin in particular has become very concentrated. So the largest miners control something like, close to 45% of the, kind of the Bitcoin mining capacity. And I'm sure you're all right aware that what is famously called the 51% attack, right, means that if an entity controls a majority of the mining capacity, they can actually fork the Bitcoin and then actually start changing the blocks and changing how things are recorded and so on. right? So that's something where right now, because a lot of miners try to locate in areas where electricity is highly subsidized, in particular in China, 6 out of the largest mining pools sit in China. There's only one, which is Flush Pool, that actually is, kind of Europe-based. And the other big ones are all China-based. On top of it, right? So that already means that they're outside of the jurisdiction of, say, US and Europe. So if they did something to the blockchain that, kind of affected American savers and consumers poorly, right? There's no repercussion, right? So this is something to keep in mind, because this is not about, I'm not talking right now geopolitics. It could be even geopolitical risk, right? It could be, but it is systemic risk. And so we don't want to be in a situation where we have to bail out Bitcoin savers from some, expropriation that happened, outside the US jurisdiction. It's bad enough that in 2008 we had to bail out, kind of US banks. We don't want to replicate this in this other environment.
Okay, so now we're talking about regulation and nation states. So there's a couple questions. There's 2 or 3 that have come in on this. Do you feel that the value of cryptocurrencies could be regulated away like gold was in 1930s? And another question that's kind of similar to this is, does the value of cryptocurrencies decrease if nation states begin issuing some sort of cryptocurrency?
Very good question. So the first question actually is, it's a very insightful question, because indeed, right, nation states can heavily affect the value of cryptocurrencies, and we already know this, right? So, for example, China banned the holding of cryptocurrencies for its citizens in the end of 2016. Prior to 2016, actually, the biggest volume of trading in cryptocurrencies was in China by like a huge margin, and that volume completely collapsed overnight. With it, actually, this was of course a time period when the cryptocurrency price, especially the Bitcoin price, wasn't as high yet, but the price was actually depressed. Now, what happened, post 2017 is that currency, currencies, let me call it currency, right? But stable coins like Tether came into being. And we have good reasons to believe that many Chinese citizens are now still trading cryptocurrencies just against Tether and on exchanges like Binance that are outside the Chinese government's jurisdiction, right? But that, still allow Chinese citizens to be engaged in this type of trading. However, but we've also seen, if you look at, kind of any different type of valuation of stablecoins, then many studies in academic finance now showing that the announcement of different type of regulations on cryptocurrencies around the world affects the value quite significantly, right? Even kind of the rumor that the US will allow an ETF on cryptocurrency makes the price go up. And then when this is clarified that this is not the case yet, and hopefully it will never be the case, as my opinion is, kind of then the price comes down again, right? But kind of this is basically indeed important. And as I showed you with the big price impact, right? The issue is that a malevolent nation state has the power, especially of a size of, say, China, does have the power to create havoc in the system by announcing certain, kind of regulations, if you want. And so this is something we want to be very careful about. Then I think the second question, sorry, what was the second?
So the other question, part of the question was, what happens when nation states start to issue cryptocurrencies?
So, right, in particular, what nation states are thinking about more is stable coins right now. So I would, first of all, kind of, I didn't say this enough in the talk. So a stable coin is something very different from this type of non-government sponsored cryptocurrency. And in the end, a cryptocurrency, this type of, say, like Bitcoin, is a fiat currency, right? It's just not a government fiat currency. So I would say the following, indeed, we already have stable coins like Tether, but we also have in many countries, right, say in developing countries, we have mobile money. In the end, that's like a stable coin, if you want, right? In, kind of Kenya, Tanzania, people are literally sending money minutes via their cell phone. But what happens there is that the cell phone carrier is not allowed to create money like banks are, right? Your cell phone company has to back all the minutes it issues for people to send around, like these tokens. They have to back it with fiat currency, government-sponsored fiat currency, right? That is held in in an escrow account. So those things, in my opinion, right, can be very, very useful in allowing to and provide more financial inclusion in areas where people do not have a lot of easy access to banks or to other financial institutions. And as you can see, right, you can disentangle the creation of a new money from the use value of these stable coins. And there might be, if they're well regulated, there might be lots of good reasons for it.
I'm going to try and summarize your answers to these. So the impacts of regulation, I take from your answer, it would be very difficult to come up with regulation for these digital currencies because they trade across multiple geographies, multiple nations. And it sounds like we already have a good proxy for these stable coins with the way that some of these existing cryptos already behave. So probably little impact from nation states issuing crypto above what we already see that's offered.
That's right.
Okay. Let's see. So there's a couple of questions that came in on your research around concentration. So one of the questions is, do you have a sense if holding the holder concentration across digital assets has impacts? Most of the attention of your talk was devoted to Bitcoin, but wonder if there's other thoughts you have around concentration in things like Ethereum or Dogecoin.
Yeah. So from we haven't done yet the same thing for the other for these two securities, for example. I would believe that it will look relatively similar from everything, kind of that I've seen. And in particular, also in place, things like Dogecoin. And the reason why I say this is not just because it seems that the participants in these different coins actually, kind of are follow a very similar pattern, but it's also, if you look at the price impact and the way, say, certain kind of public influencers can influence the price of these different currencies, it seems to kind of suggest a relatively similar dynamic. But it is something that, I'm eager to do more work on and to understand more.
Okay, thank you. Let's see. So does the lack of an arbitrage opportunity from your research suggest that maybe the market structure is somehow maturing? How has the Bitcoin future market helped in whether the market is maturing or not maturing? So
yeah, very good question. Right. So you're right that what we've seen are these price dislocations across exchanges have come down. That does indeed suggest that there is, kind of in a way the trading structures behind these different exchanges are somewhat maturing. And you're kind of the questioner is completely right. Part of it is because of the introduction of futures, even though I have to tell you, right, I mean, if you look right now, the CME CBOE futures, the kind of the amount of of a haircut basically that you get on it it's quite large, and so the big arbitrageurs are not necessarily using the futures markets to hedge their exposure. In fact, what we have seen is that a lot of large hedge funds that are arbitraging across different exchanges in cryptocurrencies, they actually kind of partner with large holders of cryptocurrencies who are relatively price insensitive and are willing to lend their cryptos to the hedge funds based, kind of for a fee. And so you see, then you have a large holder who's willing to absorb the price movements of the cryptocurrency, while you have another trader who's making sure that the price across the different exchanges is arbitraged. And so I think those are some of the things that took some time to set up and that have, that have now become kind of more prevalent.
Okay. So thinking about crypto as an asset class, if I can call it an asset class, I haven't asked you yet if you believe it's an asset class, but wouldn't the fact that there are very few holders make the currency futures outcome more idiosyncratic and imply low correlation with other assets? And maybe the fact that if there are idiosyncratic movements, maybe this is a good diversifying asset class.
So I would say the following. So I would not call it an asset class in the sense that, first of all, across different cryptocurrencies, obviously, because the protocols are very different, even the utilization is very different. It would be somewhat misleading to all cluster them together. In particular, right, I want to say that there are some cryptocurrencies like, say, Ethereum, and others that allow for much more sophisticated utilization than something like Bitcoin. So what I mean with this is, right, you cannot write smart contracts on the Bitcoin blockchain, and so that kind of limits what you can actually do. We will probably see much more innovation around, other cryptocurrencies that allow for, kind of more sophisticated contracting, different usage, of the blockchain that can be actually, provide value beyond just, say, inflation hedges and so on. Now, on the second part of your question, the fact that these are very idiosyncratic holders, whether that means it's a good hedge, let me just say, kind of flipping a coin is also uncorrelated with everything. You still don't think this is a good asset class nor a good hedge for anything. So, I just don't, kind of believe that exposing yourself to the idiosyncratic risk that is even endogenous to the whims of very large traders and their potential liquidity needs is not a good thing for anyone to do in a, in a delegated asset management position. If people, kind of, don't get me wrong, if people want to gamble, if people want to follow Elon Musk into Dogecoin, on their private dime, if they know that they are being basically misled for the fun of someone, it's not my business to tell people that, kind of, they're either stupid or they think they can beat the next best guy who is going to pick up the Dogecoin from them. Fine, right? But what we don't want is that people kind of who are not aware of these risks, or people in their 401ks and retirement savings account think that this is actually an asset class.
So your comments here reflect your prepared remarks that this is speculative, right?
Absolutely.
Yeah. You did hint in your prepared remarks that maybe there is some diversification hedge benefit against inflation. Can you expand on that?
Right, that's what people have been saying over the last year in particular, when, right, the US in response to kind of all the COVID dislocation was taking on a lot of debt, and potentially, kind of, there's a lot of concern, right? Especially, think about the last couple of days, how the Fed and whether the Fed will counter the potential threats of inflation. And the idea that, kind of, say, Bitcoin has a upper limit of 21 million coins, might suggest that, you know, kind of they might not be subject to the same inflation risks, right? That's the argument that people have made. I think, you know, maybe that, I mean, what is true is that if indeed the protocol decides to stay with 21 million, you could potentially think that, you know, then there's this type of inflation just via providing more coins will not happen. The truth is we don't know, right? They might change their mind. I mean, there have been other changes in protocol where, you know, Bitcoin Cash and other things have forked away from Bitcoin. So, you know, nothing really prevents, you know, the protocol to stay the way it is. And then the other thing is, honestly, if you're afraid of inflation risk, there are many other much more transparent ways to hedge that risk, from tips to other things that don't expose you to the same idiosyncratic risk that, you know, Bitcoin does expose you to.
All right, so here's one from Dick. He just fired a question. And so once all the Bitcoin have been mined, can you see the steady state not much different from how investors think about gold as a universal numeraire where capital markets are not well developed? And maybe just if you can preface your answer by how many coins have been mined so far, Bitcoins, out of the 21 million, how many have been mined to date?
Actually, I'm not exactly sure. I think maybe it's 18 million or something. So we're coming close. So I would say once we are in steady state, yeah, I mean, you know, if the protocol, if everything stays the way it is, then there will not others will be added. So my concern more systemically really is that the opacity of the underlying structure of Bitcoin is what worries me the most. And so, you know, kind of the fact that we don't know and we have no way of actually ensuring that we know who the miners are, what their incentives are, who is owning the miners, whether kind of, even though, you know, there are now, you know, say 7, 8, 9 largest pools, there are also lots of rumors that some of the largest pools in China actually are owned by the same entity. Those are all things that can create massive systemic risk. On top of it, even assume the miners are all really benevolent people, the people using it might not all be, right? So if you think about right now, how are we treating taxes on the block in Bitcoin? If I'm paying with Bitcoin, even on an exchange, right, like Coinbase, you know, I might have received the Bitcoin from somebody who never paid taxes on this before. So what tax am I paying? How is the IRS going to, you know, kind of assert taxes on this? Because if it doesn't, it suddenly gives a massive tax subsidy to one asset class that it doesn't give to anyone else. And it's our loss as society to stand by this, right? And, you know, kind of, especially for the US, right, which actually has a reasonably well-functioning currency, it would be a huge loss if we allowed basically a substitute of US dollar with something that is so opaque and ultimately doesn't have to kind of, if you want, report to any regulator, any US public good. You know, I don't think it can ever be in the interest of society to allow that.
Well, you've just answered my last question, which was, what was your greatest worry? And it sounds like the miners and the opaqueness of the miners and who they are and what their intents are it sounds like that's your biggest worry. But so let me ask you in our last minute, you've done a tremendous amount of work here. What's next for you? What are you going to tackle in your next bit of research?
Yeah, so you know, it's exciting time for financial markets, right? And as many of the questions already hinted at too, right? It is still the case that you know, there are lots of financial technology changes that could bring about a lot of value for society, and say a well-regulated blockchain technology or kind of encryption technology could potentially help with more financial inclusion, with more efficient management of financial transactions. While I'm against kind of allowing this type of very unregulated type of cryptocurrencies to kind of to become the way we store value. I mean, given that ultimately I'm just very suspicious that it will actually store any value. I do think that this blockchain technologies can do a lot of good for tackling true kind of issues of transactions in financial markets. So those are things that kind of I find extremely interesting, and those are things I'm working on.
I suspect you're a member of the Never Bored Club. So,
it's true.
So I know we are right at time here, and I just wanted to say on behalf of New Frontier, and Dick just came back, but on behalf of New Frontier and the CFA Society Boston, we just want to thank you for your time today. A terrific conversation on some of the questions we have on blockchain Bitcoin. Thank you very much for joining us.
Thank you.
Everyone else,
Pleasure to talk to you.
have a great day. Thanks for joining.
You too. Take care.
Bye.